Good evening, ladies and gentlemen. Start your portfolios because today I might lose some subscribers, baby, because man, when I talk negatively about Nvidia, do I ever get shat on relentlessly? But I think this video is more prevalent than ever as I keep hearing people talk about this moat that Nvidia has that they just really don't have. And I want to say why it's going to be more bullish for your portfolio from a diversity standpoint, from a tech standpoint. We're going to take a look at a lot of fun facts today that just bleed into the insane value of Nvidia. I just wanted to start a live stream this, Saturday. I have a little bit of fun this evening and just kind of educate you guys a little bit. And I promise you, there's going to be one hell of an educational piece because I've just listened to so many different bull cases on Nvidia over the last couple of weeks that they're missing out on so much because of lack of information. They're not really updating themselves on the variety of the space. And most people that buy these kind of tech companies are buying them because the stock is going up, not because they understand how chips are made, not because they understand patents, not because they understand, anything about these companies. It's just that Nvidia is a rock star. People love rock stars. The problem is the people that catch them later are always the ones that get wrecked. So yeah, we're living in a weird time right now because there's starting to be a lot of fear around geopolitical events. And I keep stating that the market is heavily overvalued. Not that I care. I'm always going to be buying, but in overvalued markets, when fear starts to bake in, the first thing that starts getting affected is speculative assets. Though gold is rallying, being one of the less speculative assets, Bitcoin is actually getting hit pretty hard, which is kind of counterintuitive considering the geopolitical uncertainty, but it's also leading to crashing going on in Dogecoin, a lot of the speculative things like Solana. So it's kind of interesting to see that, they're claiming that a lot of these geopolitical events are affecting this. So everyone's expecting that because crypto's getting hit, it's likely that the markets are going to get hit on the weekend here or coming out of the weekend into the early next week. Who knows? Who really cares? Again, don't care about the geopolitical stuff. It's just that I don't know how all this correlates to market movements other than there's a lot of rich people with a lot of big money that are causing these in and out flows, right? So we're getting those fears baked in as, the S&P 500 also suffered its worst day in January as inflation woes erupt. These kind of headlines are going to continue to persist and obviously add continued pressure on the market. So let's talk about the Nvidia crash like it's going to explode higher. Now, I'm not saying it can't explode higher from here. By all means, the stock could go higher. I just want to kind of give you an example of what you're taking on if you're buying the stock today, because you got to remember there's a lot of companies that go through very similar. There is no straight up, complete, to the moon business model. I mean, that was Tesla, and Nvidia has a very reminiscent reality of what Tesla went through from this massive growth rate. But we're going to talk about it from a fundamental business standpoint. And I want you to keep in mind right now that this is probably one of the most interesting facts before we get into the insanity behind Nvidia is that when you take a look at the top 10 holdings on the S&P 500 right now, they're all tech companies, except actually Eli Lilly got in here, but they're all tech companies for the vast majority, the most part. But Nvidia sits here at the top 3 largest company in the US right now. And I just want you to understand the insanity by that when we take a look at some of the valuation metrics, right? And what you're kind of buying yourself into here, because Apple trades at a 27 times multiple. For those of you that don't understand price to earnings, just imagine if the business doesn't go up or down in any way, it would take you 27 years to get a full rate of return on pure cash flow from a company like Apple. Now, Apple does share buybacks. Apple does so many different things. There's so many manipulative tactics. I don't think that is a very, clear and cut, dry way to understand price to earnings, but it's just a really quick, metric that a lot of people like to use, right? So if you kind of extrapolate that into a company like Nvidia, a company that is damn near close to Apple's market cap, but trades for a 74 times multiple, that means that this company has to 2.7.5x its bottom line to even justify the current valuation, right? I mean, for you to get a full rate of return out of this company, you are talking about insane growth, like growth unlike anything we've ever seen before. I don't think people really understand the latitudes that need to be achieved to justify a 74 times multiple when you're already at a $2.2 trillion market cap. That means, you're expecting this company, first it has to double. And then if it doubles its earnings per share, you're going to bring it down closer to what? Maybe a 36 or whatever, 37 times multiple. And then we're still at 37 years. Then we got to do that again. Or not necessarily again, because the doublings don't need to be the full amount from the beginning. Right? I don't want to get into the math. I should write this out on paper because it probably make more sense. But like I said, I'm not trying to get into the whole craziness. I know that Nvidia has huge growth potential behind it. We're going to get to the growth side of it in a moment here, but I just want to talk about NVIDIA's story a little bit because it is kind of fascinating. Because you got to remember, there was a time here when NVIDIA's stock was going down And it was going down because they didn't have any new revenue growth. The crypto bull run came to its end. If you go back and listen to the CEO, that's all he cared about was crypto mining. That's what everyone's buying their GPUs for. It's great. Now all of a sudden, crypto crashed. The market was coming down. People are like, oh, what do we do here? Like, no one really has a use case now outside of gaming, the traditional things we're using these CPUs, GPUs for. But then out of nowhere, ChatGPT, I think, was one of the canaries in the coal mine to this new data revolution of AI and large language models that require heavy data processing. And then all of a sudden, all these big companies, the big dogs, figured that out. And what do? They're like, we need these. We need them now. We need them like yesterday. So they started buying these up. And what do we see? An absolutely, unlike any company that has ever existed on the S&P 500, an explosion in revenue. To go from the 25 billion mark on a 12-month trailing to 60 billion, even on the quarterly, from 7 billion to 22 billion is pretty insane growth on a quarter over quarter level, right? This is highly, highly unsustainable. Even from that first quarterly growth, we're already seeing it start to slow down a bit, right? So you got to keep that in mind. And if you take a look at the price to earnings multiple, which is also kind of intriguing here, let me just find this real quick. Where's my price multiples here? We scroll down here, we can also see that Nvidia during this slump time, the price to earnings jumped up a lot. And this is where people like Kathy Wood were selling out. This is where people were highly concerned because profitability was going away, yet the company was still trading at a relatively high value, right? So, before the massive run up, it was trading at pretty absurd multiples. It was unjust during this period. What happened is completely unforeseen, except for the likes of Nancy Pelosi and people with insider information or worked at massive tech conglomerates inside the company, which is why it made no sense that Nvidia was running so much. And that's why I was saying, this is a bubble. This is going to burst. Yet clearly people knew stuff that I didn't know, and they were buying it up because they recognized there was going to be huge, buying potential here, right? And now when we look forward at the current buying potential, what's going to happen moving, into the coming quarters, we can see that their guidance is already pulling back in Q1. We're talking about 24 billion plus or minus 2% in revenue. Now they could blow this out of the water. If they blow it out of the water, the stock is going to probably run pretty heavily, but let's take into consideration that this guidance is relatively accurate. And I can't get over the 76%, 77% margin. When you make this kind of margin, baby, whether you have patents or not, somebody's coming for your lunch. You're not going to be making 77% margins on a business without people taking notice. It's like cartel level drug dealer like shit. So anyways, with a $24 billion expected Q1 guidance here, you kind of go back to this and you take a look at that revenue again. You can already see that growth is going to be slowing down. We peaked last quarter about 22 billion. So 24 billion is only about a $2 billion jump, which is a far cry from the insane 13 to 18 to 22, right? We can already see that we're starting to reach parity to some extent with all this buying pressure into these chips, because obviously we're also reaching a market where we can't supply all of these chips, right? There's just not enough supply to meet the demand, which is why we're getting away with these crazy high prices. These chips are selling for upwards of 40, 50,000 plus dollars a chip. This isn't for people like me and you. So let's talk about the people that this is meant for, right? If we read into this is a beautiful headline. What are Nvidia's top 4 customers, driving this homogenous revenue growth? Well, just like people like to discuss, it's like selling the picks to the gold, or, basically the picks to the gold miners. You're guaranteed to make money selling the picks. But again, Nvidia is not going to be the only pick maker in this business for much longer, in my opinion, but we'll get to that moment soon. But this is the real thesis that's been driving so much buying power, right? Because you got Microsoft making up 15% of the sales. They're building up partnerships because obviously, they're one of the biggest cloud providers on the planet. Meta stock is blowing up because they're also the second largest buyer of these insane chips. Again, we got Amazon in here and Alphabet. These basic 4 customers, I think, make up over 40% of Nvidia's revenue. These 4 customers dictate what happens to Nvidia in the future. This is not a highly diversified business model, folks. Just saying, 4 people are dictating everything that happens to you. So let's ask ourselves the very question, what are these 4 people doing? Again, if I am a cartel drug leader working at the scale of Microsoft, Meta, Apple, and I'm sitting here thinking to myself, here these guys are pulling silicon chips out of sand that cost absolutely nothing, that they are able to profit over 70% on, which no company in the S&P top 10 has ever made those kind of margins. How do we do this ourselves? Why are we're stuck waiting here? This guy can't even give us what we want. When you can't reach my demand and I'm giving you billions of dollars, fuck. Yeah, get your shit together, right? I'm going to keep paying you that kind of, think for yourself as a business owner. When you're spending that kind of money, sometimes it's better spent investing it into your own verticals. So with a systems approach, this just came out in November, by the way, which I'm blown away how few people talk about this. With a few systems approach to chips, Microsoft aims to tailor everything from silicon to service to meet its AI demand. Tucked away in Microsoft's Redmond campus is a lab full of machines probing the basic building blocks of the digital age silicon. This multi-step process meticulously tests the silicon in a method Microsoft's engineers have been refining in secret for years. Today, Microsoft Ignite, the company, unveiled 2 custom-designed chips and integrated systems that basically resulted from that journey that Microsoft Azure, the Maya AI accelerator, optimized for artificial intelligence tasks and generative AI, and Microsoft Azure Cobalt CPU, an ARM-based processor tailored to run general-purpose compute workloads on the Microsoft cloud. The chips represent the last puzzle piece for Microsoft to deliver infrastructure systems, which include everything from silicon choices, software, servers, to racks and cooling systems. The chips will start to roll out early next year to Microsoft's data centers, initially powering the company's services such as Microsoft Copilot and Azure OpenAI services. Wow, I'll be damned. Look at that. There's a chip that doesn't have an NVIDIA logo on it. Who would have thought? Everyone was telling me NVIDIA has patented control over this entire oil sector, like the new oil. And I just think it's hilarious because I've been arguing with people about this and they just act like NVIDIA is untouchable. And they can't even tell me how these chips are made. I'm an idiot. I'm a fucking moron, yet I can figure most of this shit out. Like, I don't know how these chips are made. Can anybody tell me how a chip is actually put together? Like how they increase the processing power? I don't know any of this, which is why I have a hard time buying into these companies. Though it's been a detriment to my returns because if I was smarter, I should have just bought SMH. I sold my Taiwan Semiconductor like a freaking idiot, so scared of this crash, knowing that I had such a good buy. I'd say if you go back to my videos, man, the dumbest thing I ever did was sell TSM. God, that was dumb. TSM is doing so well as of late. But here we have Meta. Oh my God, another company. Meta introducing their next generative infrastructure for AI. I wonder what this could be. Another chip. The next generation of Meta's large-scale infrastructure being built with AI in mind. Oh God, let's take a quick listen to this one, shall we? It's fascinating.
By having it in-house, we are able to optimize every single nanometer of the chip. So we don't have any part of the architecture that is wasted. And that helps to bring down the power.
The fundamental target in designing this MTIA is to provide highest performance in the lowest power. And in the process, we achieved twice the efficiencies compared to today's GPUs.
I hate when they say this because every single one of these companies says compared to traditional CPUs, like what, an H100 and H200, are we comparing it to the latest stuff or the stuff that NVIDIA is coming out? Like, I hate when it's like Apple. Like, until someone gets it in their hands, there's no way to actually benchmark it.
Another silicon product built by Meta is MSVP, Meta Scalable Video Processor. People spend more and more time producing videos and sharing videos. That means more and more pixels will hit our data centers.
MSVP processes these videos.
I mean, you get the idea, right? So then we have Google here. Google unveiled their ARM-based data center processor, their new AI chips, which a lot of these companies aren't even producing them for sale, right? Like, they're not trying to meet the market demand. They're just trying to basically build out their own data centers because they understand the value of this processing. The processing and scale of processing is the future. I mean, this is why, Sam Altman wants to build this like $2 trillion processing machine because he's kind of run the math on what it's going to cost to get to some kind of parity of artificial general intelligence. And these other companies aren't dumb. Like, they completely recognize that, if we just take our profits, instead of giving them to NVIDIA, letting them build this massive conglomerate machine that they're also building, like, why don't we just build our own? Like, let's find a way to own the chips and we can scale at our own pace and maximize this for shareholders because the value is going to be exponential. Whereas, I mean, honestly, when you look at a company like NVIDIA that is making a 70% margin on a chip that these companies need, 70% is just absurd. They could put 70% extra dollars, 70 extra percent of that 40,000 in an H100 right back into their own pocket and build their own damn machines. I mean, these companies aren't stupid. Amazon unveils its new chip for training and running AI models. All of these articles came out of the last quarter of last year, and people still are acting like this isn't happening. There's a shortage of GPUs as the demand for generative AI. Again, we get into the same spiel here, which is often trained and run on GPUs grows. NVIDIA's best performing chips are reportedly sold out until 2024. The CEO of chip makers TSMC was less optimistic, recently suggesting that the shortage of GPUs from NVIDIA, as well as from NVIDIA's rivals, could extend into 2025. To lessen the reliance on GPUs, firms that can afford it, that is tech giants, are developing and in some cases making available to customers custom-tailored for creating and iterating and, productizing AI models. One of those firms is Amazon. Wow, I'll be damned. It's kind of crazy that the 4 largest clients that completely control the future of NVIDIA's growth, the ones giving them tens of billions of damn dollars, trying to get these chips under their house, are like, hey, yeah, I can figure this out on our own. Like, this is taking too long, right? Like, every single one of the companies, every single one of them is like, we need to figure this shit out. And they're figuring it out, and they're just announcing it in the last quarter. It's like, I'll be damned. Like, even Tesla's been one of the biggest purchasers of like these chips. And we've known for a while that, like, I think some of the biggest value in Tesla stock is the fact that they're integrating a lot of vertical integrations through the entire suite of this, right? Like, so they got, when the AI and robotics, they've got their Tesla bot, they have the FSD chip, they've got the Dojo chip. Like, these aren't things with NVIDIA's logo stamped on them. Dojo system itself, you got their neural networks, the autonomy algorithms, code foundations, evaluation and infrastructure that comes into so much here that I think people don't take into consideration comparing Tesla to other car companies, right? So I always find this fascinating that you're looking at companies vertically integrate to pretty insane levels. And what NVIDIA is trying to do, or as far as I can tell, the recognition of, like, maybe if we form partnerships with these companies, because NVIDIA is trying to build their own software suite, their own, a large language model computers that you can rent, which they also charge like $30,000 a month for, which is insane. They know that eventually they're going to get screwed over by these other companies, especially when they reach parity with the market, because again, then these companies can charge less and less, and they can start competing for NVIDIA's lunch. And that's when we're going to kind of hit this moment that I keep telling you guys is an inevitability, that it might not happen this year. It could happen in the next 2 quarters. It could happen in the next 2 years. I don't know. But eventually NVIDIA will not be trading at a 70 times multiple at a $2.2 trillion market cap, because it's effing insane. It's like so unjustly insane that not only does NVIDIA have to basically almost triple up what they've done, they have to keep maintaining it at that level just to justify getting your full rate of return paying today's valuation for it. Like, if people thought Tesla's valuation was nuts at the peak, which it was, like, that's why I didn't own it at the top. Like, it was absolutely bonkers. Anybody buying NVIDIA right now, unless you plan on cost averaging and being very prepared to buy some major dips, which I do with all overvalued companies. Like, hey, if I'm buying Tesla today, I recognize that I expect it to drop a lot more. So I'm going to do this very efficiently and very slowly over a long period of time, because to go one and done, to large lump sum into these kind of companies, you are taking on such excessive risk that it is just absolutely bonkers. So we'll read into a few of these comments. We'll talk about some other stocks, because there's a realm of dividend things going on that are truly fascinating as well. NVIDIA destroyed all its competitors, Intel, Google, Marvel. Those chips they come out with is a joke compared to NVIDIA. Yes, that is truly the case. But let's say you make a chip let's just like put it into an example here. Like, let's say you make a chip that is half as efficient as what they're just throwing numbers out. Like, these articles only came out, again, November of last year, right? So I don't know what the efficiency scale is, because I don't think anyone's sitting here and benchmarking them. I'd have to do a little more digging to see, if anyone's got some fun data cases on it. But let's just say it's even a third less efficient. If that third less efficiency only cost me a 20th of what I'm paying NVIDIA, I could easily just make 3 of those chips and just build the suite out, and then I'll have that same compute power. Yeah, I'll need 3 extra chips, but those 3 extra chips are costing a hell of a lot less than 40 or 50K that they're making 77% margin on. That's what you got to understand. Like, nobody is going to want to pay that kind of money. I'm just telling you, if you were a drug dealer, if you are a business owner, what do you do when someone's coming for your lunch, when you're coming for shareholder return? Chips, even look at Canon. Canon is trying to compete with these lithography machines, right? At the end of the day, like, this is one of the most valued businesses on the planet. And if I was running a company like Google or Amazon or whatever, and I had $100 billion in cash, you really think I'm just going to flood that out to NVIDIA? Yeah, in the short term, I will, because I need these chips. But in the meantime, while they're delayed by a year and a half on getting me what I need, I'm going to start building this myself, because I have the money and the resources to pull it off. And again, silicon isn't exactly the most complicated fundamental thing to get. It's not like I have to go to some crazy mine out in the middle of China somewhere and bribe a bunch of people to get that stuff. I could just go to the beach. It's not like these things are complicated outside of the formulation that they're using to compress these things down, right? So, like I said, efficiency only matters so much if you can scale it, right? Because, why would I buy an H100 if I can, for the same price or half as much, build the same kind of compute power? But yeah, I might need 3 or 4 extra GPUs. Just saying, not bad words, lol. I love bad words sometimes. YouTube's gonna stop me from monetizing this. They spent $10 billion on research and development on the B200. Nvidia has $100 trillion of companies at their GTC event. Nvidia only represents 2% of that market cap. Yeah, Nvidia is going higher. Future split. No, again, it could go higher. I'm not arguing that it can't go higher. I'm just saying, like, people just sit here and act like, again, this is kind of, maybe I just recognize it because I went through it with Tesla so much. Like, again, Tesla went through an epic run and it was the same exact thing. It felt exactly the same. Let's just pull Teslas up as from a micro. I think this is a great example, actually, because there's no straight up into the right business. And I'm just saying, when you get caught on the wrong side of this and you see how much like Tesla's crashed and it continues to, like, you just have to recognize it's very likely, like, it is highly more likely that it's going to happen to a company like Nvidia. Because again, Tesla was on this massive growth phase, and I'm curious to if Nvidia has the same capability, right? So if we just take a quick peek here, let's just take a look, because Tesla's starting to get over this hurdle, and people know that the growth is done, right? So Tesla trading at this crazy 70, 80, 100 times multiple that it was trading at, it made a lot more sense when the company every single quarter, was getting these massive, massive jumps. But now all of a sudden they ain't getting those jumps. Tesla's reaching parity with the current market, right? And that is a concern. That is a valid concern for the valuation of the company. If this does not keep going up, you can't justify those multiples. So you have to ask yourself, like, how long can Nvidia keep growing like it was? If it keeps growing like it is, yes, it can easily justify a 70 times multiple. But if we we are, you can look at their quarterly earnings. They are no longer projecting out the same kind of growth they have been over the last year. It is starting to slow down. So if it starts to reach parity like Tesla has, say goodbye to a 70 times multiple. It is no longer justified. This is what you're betting for. And if this stops, you will lose money. I'm just saying. And I think it's more likely now than ever. And I would be shitting my pants because I don't understand this industry. And yes, it is very hyped. Tesla was also very hyped and continues to be. But you have to justify that growth does not go on forever. It just doesn't, right? So I saw your videos on MPW earlier. Yes, I wanted to talk about this. Tesla can't get to the self-driving taxi cars. The stock is sub 100. Yeah, I honestly hope Tesla goes sub 100. I'd be really happy actually if it goes sub 100. I don't think it's going to happen because I think there's too many idiots out there like me that are willing to buy it even sub 150. Hell, I was buying it at 190 for Christ's sakes. I don't really care. I'm just starting my position in it. But I think, like I said, Tesla this year is going to be abysmal. By 2027, I think it is going to be another one of these crazy growth runners. There's going to be a lot of risk with that. I really think if self-driving hits a roadblock or something really bad or catastrophic happens, like it did to, say, Cruise, which is why Tesla has to take this super seriously. It could completely halt their entire self-driving, by regulators. Because Google is allowed by regulators to scale like they are now into 4 different states, I think. They're scaling in a very, methodical way, whereas, Cruise tried to do the same thing and they had one bad accident that, was not semi their fault. That basically caused them to run over somebody. And that completely halted their Cruise program. But the fact of the matter is, when this gets solved and Tesla's like on the forefront of this with Google, whoever like really builds this suite out, like, I just don't think people understand the value of that hardware, man. And, there's only 2 companies that are really on the forefront of it. And that is Google and that is Tesla. That's why I own both these companies, because that is going to be $1 trillion software. And there's only going to be probably maybe 3 or 4 competitors, likely only 2. And when you're basically subcontracting that out, because every car by 2030, I think it is going to be, you will not buy a car that doesn't have self-driving software in it. I think by 2030, you will look like an idiot if you were still buying a car that doesn't drive itself. If you even need to buy a car. Now, 2030 is a bit closer. I don't think we'll get to that full suite of self-driving where your robo-taxis are everywhere. Maybe we start getting a ramp up a little bit more, but honestly, I think every single car is going to have to license this stuff. So you're going to see GM, you're going to see Ford, you're going to see Toyota. Like, they will have no choice but to license the software, because I think nobody in their right mind is going to want to buy a car that doesn't drive itself, especially if it's a subscription-based model for like $100 a month. I would pay for that. If I could get a cheaper car, if they can come out with some more affordable models, and then I can pay maybe whatever for self-driving at $100 a month. That's a pretty good trade-off for a chauffeur. I'm just saying. So let's talk about MPW here real quick, because I am going to get into this. Yeah, so it's not over 1,000%. We'll talk about this real briefly because I've been debating on, I still debate on this. I haven't done it, and I'm just watching it because the price action is so fascinating. Is the short squeeze, right? Outside of these tech companies, the short squeeze that can go on, I haven't seen anything like this. It's nothing compared to like GameStop kind of short squeeze, but it has the real potential to it. And the company is continuing to prove they have incredible value underlying the hood of this business, because the stock also got squeezed into after hours and it pinched it up 13%. And you see these massive fights against shorts and longs that have been going on because you get these massive, insane 20% spikes in like a day, and then it crashes again. The 15% dividend yield. A lot of people keep asking, is this sustainable? What's the deal with this company? They've had a lot of press releases recently as they've been getting rid of this is a medical property REIT. They unfortunately were using, third parties, subsidiaries that were buying assets that weren't nearly as solid as they were told. And when the interest rate cycle and all this shit kind of came falling apart during and after the pandemic, it really, really screwed their business up because they had terrible assets that they unfortunately had to get rid of, but they were getting rid of them at really good values. So they just generated $1.1 billion, year to date, $1.6 billion, continually liquidating, not necessarily bad assets, but assets that are valued to start paying off debt and bad debt and, against some of their terrible subsidiary. I think that subsidiary made up 30% of their total earnings or something. And the dude was like swindling cash or some shit and putting it into boats and yachts or whatever. I'd have to go back and abbreviate some of my videos where I talked about it because it was a pretty bad dealing for a company like this. But basically, the company right now is doing a fabulous job at raising a shit ton of capital while also maintaining this absurdly high dividend. And the dividend, I'm debating on whether how sustainable it is because I don't know what kind of assets they're selling off, but they did just declare that they are paying another dividend at 15 cents, which is why the stock jumped up as well, because they haven't posted earnings yet. And if they pay a quarterly dividend before earnings, I think the earnings are at the end of the month, that really kind of solidifies that, hey, like earnings are probably not going to be that bad. We can probably afford the dividend. That also scares the crap out of some short sellers. So they're probably closing their shorts, driving up some of the stock price, right? Because the company has 19 billion in assets. They've got about 10 billion in liabilities. They're going to pay down another 1.6 billion of that, but keep in mind they're losing their asset values. So their asset value is going down. But if this company was actually valued at these prices, the stock's trading at a frigging insane $2.4 billion. In fact, the company's almost raised half its market cap value, or more than half its market cap value just this year. This company has liquidated enough real estate to justify $1.6 billion. I mean, that's more than half the company's freaking market cap. I'm like, how crazy that is? I'm like, this thing is trading for, insane value if the underlying assets are actually worth something, right? So if we take a look again at the balance sheet, what I find most intriguing here is they've been able to keep revenues actually for the 9-month end. Again, this is just from rent build. Total revenue is actually fairly reasonable. It is going down because, again, they're liquidating assets, but the revenue is relatively strong. $306 million for the 3-month end. I mean, almost $1 billion. The company's generating almost, just under 50% of its total asset value or total market cap value, which is crazy to me. And then you take a look at net income, right? If you take a look at the net income here, I mean, net income is about $116 billion or 116 million, which isn't too bad. I mean, justify earnings per share was 19 cents. Again, keep in mind, this is like the last quarterly for the 3-month here. But if you take a look at the 9-month, and we're going to pay attention to this because, again, it's going to come into conclusion to why they can't afford the dividend. But for the last quarter, they justified their earnings. They brought in, 19 cents of earnings per share. Their dividend was 15 cents. So they had lots of room to pay that dividend. But if you take a look at the year to date, I mean, because this, again, for the 9-month ending, they only justified 18 cents in total earnings, whereas they had 73 cents in dividends. So, I mean, how do they justify that? And this is something that I have to constantly explain because I don't understand how people don't understand this. But if you take a look at the depreciation and amortization cost, and you take a look at that for this ending period, it is insane how much they've been depreciating because their assets have lost value. They're going to write that off against that income, so they don't have to pay tax. It's actually better for you as a shareholder that they do this because then they're not double taxing the crap out of this money. But again, if we take a look here, where did I just lose that? The depreciation. Let me make sure I got that here. Where is that? Go back to that. So the depreciation and amortization was $1.3 billion. They depreciated just under half their market cap. It's like, whoo, baby, this company is working with big dollars against their market cap value. This is what's so crazy about it. I'm looking at this company and I'm like, my God, man, like depreciating $1.3 billion in value. So again, that's not getting added to the bottom line. So yes, they can afford this dividend for now. I don't know where cash flow is going to be in the future, but they have lots of room to keep paying it as far as I can tell. And this last quarter really justifies it, right? I mean, 19 cents. Is there not going to show me direct depreciation? Oh, right here. Yeah. So they depreciated about $77 million in assets just for this quarter. 77 million is a pretty big chunk of change, if you ask me. I mean, that's probably almost enough to pay the entire dividend in and of itself. So their interest expense has gone up dramatically. I mean, this is another one of these recovery plays because their interest expense went from like, actually it depreciated a bit. They're actually, am I seeing that right? No, we want interest expense, total expense. Where's that interest expense? Yeah. So their interest expense went from 88 million to 106 million year over year, and from 266 million to 308 million for the 9-month ending. Yeah. They're like every real estate company. They need interest rate cuts. This is one of those companies that could really benefit explosively from an interest rate cut cycle. And the best part about it too right now is they're actually pulling shares off the table. On a year-over-year basis, it actually looks like their diluted shares have actually been decreasing. Also something very intriguing to take a look at. So yeah, this company I think is probably going to be one of the most fascinating stories of the next year, 2024. I think if you're into companies that you like really getting finicky and in the books, listen to this earnings call, get a feel out for it. I've been debating on adding it to my RSP for a while. I still might, just as a joke, pick up a few shares just to see, just keep an eye on it, just to own it, to keep an eye on it, because I think the story is too fascinating. Because I think there's sometimes good disconnects on values of stocks still. It's really odd that in such an efficient market and how everyone has access to all this stuff, you just see these crazy ebb and flows. And just again, this is why numbers are pure fugazi, because you can't really justify where a business is going in the future unless you work in that business. I don't understand chips. I don't. Obviously, why would I buy chip companies if I don't understand chips? I bought TSMC because I think I understand the lithography machines. I understand how these things are produced. I get the whole infrastructure of it. I get it. I just, back then was the time to buy it, and I should have bought SCMH or whatever the semiconductor ETF was. That was the prudent thing to do, but I was getting a little weak-handed because the markets were so uncertain that I'd rather just own a broad-based ETF, which wasn't a dumb idea. I mean, I'm up massively on my decision doing that, and at least not parking anything in cash that much. It's always good to just be in the markets, but my God, guys, unless you know these businesses, you can't sit here and just be bullish on these stocks. It's really hard to be bullish. I don't understand medical friggin' properties. I just know that the fundamentals of the business, the way I'm looking at them today, are interesting. They're fascinating because the value setup is dramatic. It looks like the stock's trading at a massive discount. It's massively shorted. They're able to get tons of liquidity. When you just look at all the dominoes that are falling, it's just, where does it take us? That's my intrigue. Not that I want to own the stock as much as I want to see where the story goes, because some people are going to make a lot of money. And there's a lot of people betting on it going the other way. A lot of people are betting that it's basically going to go bankrupt. And it doesn't look like they're going bankrupt. So when do those shorts cover? I mean, if you're over 30 or 40% shorted, I mean, the upside that could come from that is insane. And that's why you see those massive spikes. It's fascinating. DOL keeps running, Kyle. I know you're not a fan, but they've been killing it. Let's take a look, shall we? DOL. What do we got for the DOL? Are you talking about Dollarama? The good old Dollarama. I don't not like Dollarama. I wish I owned it earlier. I think it was another one of those stocks that way back in the day I might have bought and sold. They're just trading at a 31 times multiple. Let's see what the depreciation is on a company like this, actually. For those of you that are interested in the recession-proof businesses, I don't think there is a more recession. Actually, this is proving to be the utmost recession-proof. Let me just get into the investor relations here. Let's take a quick looky. See where Dollarama sits today. Governance, sustainability. I haven't been in here in a while. Can we get the past earnings, Q4 earnings release? Just take a look at the financial statement. Yeah, because you can't justify a price to earnings multiple when there's a lot of depreciation, which again is something that Nvidia doesn't do to a huge major extent. But let's just take a look here, because what I want to look for specifically is, because I never looked at the depreciation of Dollarama. How much are they writing down? A lot of money, actually. Yeah, so their price to earnings might actually be more favorable. Again, if I ever look at a PE and I say it's overvalued for that reason, you probably just look at me like I'm an idiot because I haven't done my due diligence. Because you really, really need to dive into these books, and you really need to take into consideration, these depreciation of assets. Because when you look at the depreciation and amortization, technically you should be adding another $348 million to the bottom line, which is literally, that's more than 1/3 of their entire general administrative and store expenses are this company has crazy write-offs, right? So I mean, these depreciation that's crazy. So let's just take a look at the revenue here. Let's go back up to revenue. Assets. Did I pass it already? Let's take a look here. Total net earnings. No, I want to take a look at just the revenue. Forget net earnings. Is it not going to show me? This one might just be showing earnings over revenue. I could probably just go take a look at the money Yahoo Finance, but I'd rather, they're even bringing in interest revenue. This company's got enough cash to generate $27 million. Yeah, I don't know. You got to really dig into this stuff because it's fascinating, man. Total depreciation. I mean, their net interest income here is huge. Just make this a little bit easier for everyone. Let's just take a look on, again, I don't like using Yahoo Finance. I just don't want to waste your time because sometimes I could spend 10 minutes just trying to figure out where the numbers are at. But let's just take a look on here real quick. So first of all, total revenue at $5.8 billion from $4 billion is a nice growth rate from 2021. Yeah, that chart is absolutely gorgeous. People love the Dollarama, even though things don't cost $1 anymore. What about the dilution? It looks like they're actually buying shares back too. Holy crap. So the company is bringing a lot of shares off the table. The revenues are growing. Yeah, this company has actually the perfect formula for success. Just a base look at this. What do their assets look like? Considering they have a lot of stores, 5.2 billion. Yeah, so total liabilities. Again, this is not, this is kind of reminding me of McDonald's or Starbucks when we talk about retail and how they tend to have pretty equal debt to asset ratios. To generate that cash flow. But honestly, from a cash flow standpoint, that income and those shares, like this is the formula. If I could really boil down the best stocks to buy in a formula, this is it. Like obviously I'd prefer to have a better balance sheet, but again, the company is not only generating interest from, just high interest income off how much cash they have. So let's take a quick look. What is their total cash? 313 million in cash. And that's up huge. Man, they parked a lot of cash on the table since they're, 01 of 2023. That's pretty good comparison to this year. Wow. Yeah, I don't know, man. Everything about this looks great, actually. It's not. I should have taken a deeper look at it before. Congrats if you bought this. Good for you, man. If you've been getting some gains out of this, this company's on the right trajectory nonetheless. But what a great formula. Buying shares back, great growing revenue, driving up net income value, doing everything that a shareholder loves to see. SMSH is 20% of Nvidia and is like 27 holdings like it. Yeah, I won't buy it now. I think SM&A. Isn't what's his name shorting? Isn't Michael Burry still shorting the semiconductor space? I could be wrong. I wouldn't short it. I don't have the balls to short it, but you can recognize the whole ETF is highly overvalued. All my portfolios in Tesla stock. Will this war affect Tesla? It is. It absolutely is. That's the Red Sea problem. Well, I think a lot of that plays into some of the Red Sea problems, right? To some extent, there's a lot of geopolitical events going on in that area. It's affecting a few companies. Your thoughts on ATD? I don't like ATD as much because they have such exposure to gas stations. I have a real fear for gas stations in the future because I think most things are going to come down to charging stations. And I just don't feel like most people that, start charging their cars don't go out to charge them. They charge them at home. At least most people I know that own an electric car charge them at home. So it really defeats, I think you're going to see a real step down in that. And I know they're trying to pivot. I know they were getting into, I haven't done a deep dive on them in a while. For those that are interested in this company, and I'm not trying to be negative on them. I'm an idiot. Don't take this as I'm a clown. Don't take my advice. I could be wrong because it's been one of the best performing Canadian stocks, and now it's trading down by about 12%, which could favorably be a good discount here. It's had a great run over 5 years. It's just that they're like a highly retail oriented store. They rely on things like Max Milk. Those. I'm sure you guys have seen them if you live in Canada, especially. But basically, I know they have huge exposure to gas stations, and it's like one of the major revenue drivers for them. And I know they've been trying to shift into like marijuana and all this other really competitive stuff. And I'm just curious to see how. I got to find the English. Let's go to the English website. I'd have to take a look at their presentation. Maybe I'll do a deep dive on these because I know they're really favorable in the Canadian economy. And again, I'm not like trying to crap on them. They're globalized. Looks like they're all over the place. Again, stupid. I think I'd like to see what their exposure to Canada is. But globally, they got 16,700 stores in 29 countries, right? So you just kind of got to look at the future. See how it plans in. I don't want to say anything that's stupid because I don't know what their gas station exposure is. I know it's just a big part of their portfolio. Low yield, but around 20% dividend growth a year. Definitely a sign of a great company. They're great companies. Right now, they look amazing, right? You always have to look forward, right? Like, because again, any company can look great. If you're in Canada, you probably thought Algonquin Power and Utility Corp was great. You probably thought Lavalan was great. There were so many great companies, and then it just turned out they weren't that great. It took one bad event to quickly realize they're not that great. True North REIT. Some of these companies used to be the pinnacle of what greatness looked like, but it took one shift in an economy to prove that these companies did not have great underlying businesses, even though the balance sheet looked good and everything looked good. So if you're buying individual stocks, it's so prevalent to at least have some understanding of the business. You need to listen to those earnings call. Like, you need to go talk to employees. Like, I don't think investors like recognize that enough, which is why it's just easier to buy an ETF. Like, I like gambling and speculating, obviously, but you got to recognize that you don't know all this shit. That's why I think it's hilarious when I look at an investor that owns crypto and owns Nvidia and owns Pepsi, and I'm like, just because you eat chips doesn't mean you understand the infrastructure behind Pepsi. I mean, Pepsi's been struggling as far as I can tell as of late. Like, not all businesses are great forever. That's the problem. So if we're living in an age of innovation, I would rather own the companies that are more innovative and are on the forefront of technology than the companies that have been stagnant for so long. Even like, again, this is why we're so tech heavy exposed, because tech is expensive, but in 10 or 20 years, if robots are walking around and cars are driving themselves, these tech companies will not look that expensive anymore. I promise you that. You're correct about ATG. Gas is a huge revenue source. Yeah, again, it's not going to happen tomorrow. Like, again, I'm just talking about if you're building, like, again, today, if you're looking for growth, there's nothing wrong with buying these companies today and getting good growth out of them because they could continue to grow. It's just that if you're looking for like a 30-year period in a portfolio, which, let's use my parents as an example. My parents are in a situation where, like, if I died tomorrow, like, are they going to be okay? Because, again, my mom's not dumb. Like, she can manage her portfolio, but like, I oversee a lot of it because, like, again, I don't think people are going to care about her as much as I am. And because I look at the markets every day and I understand like what the most de-risked portfolio would be in retirement, I'm going to put her in that kind of a position where she never has to touch it. She never has to worry about the companies that are in it. She can just pull the cash flow out, and it's going to last her for at least the next 30 years of her retirement, at least until, God forbid, they pass on. That's kind of the thought you have to have. But if you're 20 years old and you're buying one of these companies that is heavily leveraged into gas stations and you plan on just owning it forever, like, you have to have the cognitive skills to recognize that business is going to change. And are they, effectively evolving? Because if their idea of the future is marijuana shops, I don't know that's enough to sustain the insane amount of gas stations they're running, right? Like, you really got to take all that into consideration over a 30-year period if you're building out like a long-lasting dividend portfolio. Like, I honestly think companies like Enbridge will have a longer-lasting stance than a lot of these kind of retail-oriented stocks because, again, like Pepsi, for example, there's other competitors out there that are taking some of their lunch. Same thing with like Procter & Gamble. I used to like have such high respect for Procter & Gamble, but now people like myself are buying off-brand stuff. Like, yeah, you might love some of these brands, but they can only jack the price up so much before you're like, F it. Like, I'm not going to eat Doritos. Doritos are my favorite chip. The last time I ate Doritos is, I don't even remember. Like, I buy Takis. They're kind of expensive, but they're still cheaper than Doritos. I mean, like, I just, because again, maybe not everyone's like this, but I can only think through my own perception. And I'm just not going to buy shit that's, getting too crazy. And eventually you'll move on. People are not charging always go into stores and buy things while they are waiting. People that are charging always go into, yeah, no, I agree. But that's why they're at malls, right? Like, honestly, the inevitable future is you're not going to go to a gas station to charge your car. Like, you're going to go to these malls. You're going to go to your office. Your office is going to have a charging system set up. Our condo has a free charger downstairs. So, like, why would I go pay for it if it's included in my maintenance? Like, my own condo will cover it for me. I mean, I'm not going to go to a gas station anymore. And there's tons of Teslas and electric cars in our building. I mean, I even on my parking floor, there's like 3 Teslas next to me, and there's some guy driving like, there's EV Porsches. We see all that stuff. Your recommendation for good ETFs and FHSA, easy VFE, man. Honestly, like the end all be all of portfolios is the S&P 500 VOO or SPY. It is the most beautiful, magical system I've ever seen in my life. It's, I wish, like, I don't even know how to express or explain, like, rest in peace, your soul, Jack Bogle. Even Buffett, the greatest investor of all time, like, marvels what Jack's done. Like, I mean, if you really look into the history of Vanguard and you recognize that Vanguard doesn't want to get into crypto, and you look at longevity, security, low maintenance costs, like there are no comparables. Like I do like the QQQ ETF for some growth. Like there are ETFs that I like that'll parity with it, but at the end of the day, like 50% of our portfolio is likely going to remain the S&P 500 moving forward. You just can't deny that it is the most beautiful, awe-inspiring thing that has likely made more people rich than any fund manager, any mutual manager alive, with the exception of maybe Warren Buffett, maybe the exception of a handful of guys. But, you know, even Buffett is like, I'm just going to put all my wife's money in the S&P. Like, I'm just going to put all our money in VOO. Like, yeah, like these two ETFs are great. I don't think you need to put all your money in VOO because like you need some global diversification over time. Like my parents, again, in my parents' circumstance, if you're in retirement, it's more about preservation than it is growth. But if I'm looking for an FHSA, if I'm not looking to collect cash flow today, like, yeah, I'm going to be paying attention to more growth-oriented ETFs. And I honestly say that VOO is a growth ETF. It is primarily a tech ETF. Same with Qs, right? Like you can pair a lot of these ETFs together. They're great. There's nothing wrong with them when you're younger. Once you get older, you want maybe some diversification. You might want some VFE, or sorry, VDY, or you know the XEIs of the world, your Canadian stocks, and your Chinese or Japanese like foreign exposure. You might want to buy one of these globally diversified things, or you want to buy some European stocks, Hershey's. You might want to, which is why SHD is wonderful, or you know British American Tobacco. You might want to buy some of the addiction sin stocks for income or whatever. Like you might want to even buy some stocks that aren't listed in these ETFs. There's a lot of great companies out there that aren't listed in these ETFs. Like one that I talk about a lot, actually, that I'm always fascinated by because my mother's fascinated by it is MCAM Mortgage Group. Hopefully it does well. It's a small percentage, but this company is fascinating. I mean, MCAM's been around for a long time. It's paid a massive dividend yield. It's survived so many different recessions and depressions. It pays this crazy 10%. The price to earnings on it's incredibly low. It is volatile. Keep in mind because the dividend payout's huge. It does 20%, 30% mood swings on a yearly basis, but the company is sustained very well. Very, very well. So, I mean, you don't even, like I said, diversity can come outside of ETFs as well, because they're not going to expose you to everything that might be good for your portfolio. And I'd prefer a company like MCAM perhaps over maybe some option-oriented ETFs, just my opinion. What is VXC? We'll take a look at one more here, and then I'll get out of your hair after losing half my subscribers to bitching about Nvidia stock today, which is always fun. Sorry, I just speak my mind. I'm a financial clown. You don't have to agree with it. And I got to get people on here to debate. I miss the old debates. We're up 36%. This is the Vanguard FTSE Global Cap X Canadian Index ETF, all capped Canadian. So this is the Canadian counterpart to a global ETF. Let's take a look at the holdings, shall we? I imagine it's going to be largely leveraged in tech companies because why wouldn't it be? It's got a 0.2% expense. Again, Vanguard being a beautiful ETF provider with some of the lowest expense ratios. It's not really bad. A 1.55% starting dividend yield, which I think is higher than the S&P 500 today. Let's take a quick look here, shall we? Since inception here, let's see, you would have gotten a nice return. I mean, back since 2014. I'll get this out of my way. $10,000 over a 10-year period would be worth $27,000. Pretty nice return there, almost tripling up your money. If we take a look at the holdings, first and foremost, diversification. Emerging markets are about 9%, North America 64%. You got Europe here. You even got some Middle Eastern stocks, so that's kind of cool. Pacific about 10%. Getting the United States making up 63%, Japan at 6%. Yeah, so yeah, I mean, you're primarily just owning a lot of U.S. stocks, but you're getting a good diversification. I mean, almost 37% of the portfolio is diverse, or 36%, I think. Technology, yeah, obviously it's all going to be an Apple and stuff. Let's take a look here, shall we? Oh, no, actually, it's just, so it's a diversity of ETFs. Look at that. Okay, so you're just owning an ETF that owns ETFs. So you got the Vanguard Large Cap, Vanguard FTSE Developed North Cap. Yeah, I mean, this is truly preservation and growth, right? Like this is a great ETF. Because obviously if the US ever goes out of favor, you're going to upperweight the other ETFs. Yeah, I mean, this Vanguard system, putting it toward like a global portfolio is probably the safest and smartest thing you could possibly do. By all means, like I think intelligence at the end of the day is turning your TV off, buying an ETF like this, and just forgetting about everything else and just buying it consistently and do that for 20 years. You'll probably be retired, especially if you can put 1,000 away a month. I mean, you probably wouldn't even have to do it for 20 years if the market keeps going in the direction we're going in. It'll be fascinating. It's going to be fascinating to see what happens. I think the next 10 years is going to be the most fascinating period ever in human history. I don't think you could ever look back outside of maybe the moon landing. I think the moon landing was probably one of the most technological jumps because I mean, it all happened, I think, within a decade from the time that Russia first put like a satellite in space to when we actually landed on the moon. Like, it was such a short period of time that all of that kind of unfolded. And considering humans only achieved flight, like what, not even 60 years before it or whatever, like, it's crazy, man. It was a crazy period. And it was a shame that that technological jump really fell off, because the space evolution led to so much technologies we use today in global infrastructure. Kyle, I like your approach to investing, a hybrid of ETFs and stocks. Would you deep dive some ETFs that investors might be interested in? Yeah, for sure. I could do some more ETF oriented videos. I think your subscription would appreciate that. Yeah, I mean, you guys recommend some really good ones. I should do a broad-based ETF from, like, you know, the S&P all the way down to small caps to global diversity. But I think at the end of the day, like, you know, you don't need to overcomplicate this. Like, you could really honestly just buy the S&P and forget about everything else in this kind of market environment, because it's going to drop for sure. But at the end of the day, I really look at those companies with pure awe. Again, they're expensive. Nvidia is expensive. Microsoft's, like, the top holdings could correct and it could adjust the market a bit. But at the end of the day, like I said, come back to me in 10 years and we'll see if it was a mistake. Because I have a hard time believing we're living in that 2000s period. And I just want to point this out because there is substantial risk. And I want to point out why I buy dividend stocks still, because I think buying dividend stocks in your 20s and 30s is dumb. I did it. I felt like it was a detrimental mistake to my portfolio. I should have been more oriented toward growth companies. And I had a lot of growth companies. And I excelled and I outperformed the market, but I should have did a lot better. And my biggest regret was not leveraging those tech companies a lot more than I did. And it's you know, it's kind of a stupid thing to look back on and be annoyed about, considering how well I've done. But the problem is like, this period scares the shit out of me. I mean, when you went through the tech bubble, and I don't think we're anywhere near the tech bubble. Like, a lot of people are comparing it to the tech bubble, but I don't think we're anywhere near close to where we were back then. But I mean, if you were buying the S&P during 2000, you did not see a return if you bought shares at the very top, which you should be cost averaging, because you're not going to lump sum at the top of the market. Nobody does. And if you do, you're an idiot. I mean, that would be insane. If you had like $1 million to invest and you bought it at the top of the market, you saw no rate of return until like 2012. I mean, you had to wait 12 to 15 damn years before you started getting a return. That scares the crap out of me. So that's why I hold companies like SCHD, because I recognize that, hey, if a black swan event, which none of us can predict, hits the market in a highly impactful way, which could be, you never know, nuclear war, another pandemic, like, you have no idea. Like, nobody knows what tomorrow brings. You got to live a little for today, right? And that's why I see the value in dividends, because dividends allow me to live today. It allows me to have capital to reinvest today. It just kind of alleviates some of my concern over, you know, what could happen tomorrow. Because if it's a solid company that's an infrastructure oriented company, you know, no matter how bad the world gets, you're probably going to want to keep your power on. You're probably going to want to keep going to the grocery store. And I'm sure the powers that be will fight to maintain that to any extent. So I feel like, you know, we might take a hold on tech companies or something, but we're always going to need grocery stores and some of the fundamental tools that I think would be around during a more non-friendly period of human civilization. But we'll know. Who the hell knows? This could all change tomorrow. I could die tomorrow. Who the hell knows? We'll find out. Pray to God we don't. Live the dream. Get to retirement early so you can enjoy the time you got with your family and your friends, because that's the only value that exists. I think they're the best saying was this old guy I recently listened to, and I wish I saved the TikTok because it hit close to home. Because I like, when I talk about the 10-year prison sentence, that if you want to retire early, like I'm trying to do, that 10-year prison sentence of just living frugally as possible is the most important thing you can do. But I don't talk about the other half of it, which is like work. And you have to grind, right? Like, I mean, it's not just about being frugal. It's also about like maximizing your income potential. But when you do that, you're giving up so many other, you know, valuable things in your life, like your time and your family, and the time could be spent enjoying your family, right? Like the people that matter the most to you. So this guy made a really good point, and he said, the thing that I regret the most, you know, this guy was like 80, he says, was working too much. He said, you know, if I knew what I know now, he said, I would have focused more time on going out with my friends and family than I would have working so hard. Because, you know, he's like, making the money was great, but when you get so old and you've done nothing but save it, and you never spent that money while you had time to spend it on your friends and family while they were still here with you, he said was his biggest regret. So, I mean, like, I'm always kind of toying that in my head, because I'm working like way too much right now. I'm glad that I can spend time with my wife. It's all work from home. That's great. I make time for friends and family, but, you know, I always look to the future being like, in the next 2 or 3 years, I'm winding back. You know, when I get to 33, 34, that's it. Like, you know, I hopefully have the mortgage paid off, hopefully sitting in a relatively healthy financial place, maybe not to be able to fully retire, but enough that, we could float our bills if anything bad happens or whatever. And then I can just, alleviate my work that I'm doing and maybe just focus on live streaming, maybe just focus on, working part-time, because that's really the dream. It's really what we want to get to here. But stay cool, stay awesome, folks. Peace.